Fear in the market is high, and although it seems we are recovering a bit on the fear index versus previous week, and the S&P 500 climbing up a little bit, most YouTubers are worried about the short-term future. And you know what sells best? Fear. And I have another one for you. Most wealth is accumulated when the market is in extreme fear, and you can buy your favorite stocks at cheap prices. So, instead of selling, I would recommend buying stocks at a high discount. And in today's video, I'm trying to show you the other side of market crash. The one where we stay calm and buy high quality stocks. So let's dive into these 6 stocks to buy right now. Starting the list with a tech giant, Microsoft. And it wasn't a great start of the year for this tech giant, down 7% on the year-to-date chart, and down 15% from their year-to-date high. And the current PE ratio is hovering around 30, which is a bit on the higher side looking at their history. So most people would argue that Microsoft is overvalued. However, looking at the forward PE ratio, which is in my opinion significantly better to look at with these type of fast-growing tech giants, we see that they are sitting at 26, which is not too bad for one of the biggest companies in the world that is still growing double digits every year in revenue. And with revenue and margins both increasing at a really high pace, I think it's fair to pay a 25 forward PE ratio for this type of company. And with the stock coming down drastically, it's also a great way to boost your average dividend yield. And Microsoft is a typical dividend growth stock in my opinion. I'm really bullish about the future of Microsoft, and this correction is one of the best things that could happen. It allows all of us to buy shares at cheaper prices, while the company is still doing an amazing job. The next stock that I would love to add to my portfolio is Salesforce, ticker symbol CRM. And the main reason is because of that massive drop of 25% from their year-to-date high. Most recently they reported earnings, where they missed on revenue by a slight margin. But for the upcoming earnings, almost all analysis expect another miss, driven by the weak outlook of the company. And to me, the sell-off was a bit overreacted. And the 12 trailing month PE ratio is sitting at 42, clearly showing signs of overvaluation. However, looking at the forward PE ratio, they are just trading at 25, which is a really good deal for this tech giant. Especially taking a look at the revenue that is going up really steady and consistently historically. And it gets even better. Margins are increasing at a really high pace as well. And on top of that, they also pay a small dividend. So to me it feels like a great deal, and very soon I will do a full deep dive on the stock. Another really interesting stock that caught my attention is WR Barclay stock, ticker symbol WRB, and I think it's the first time that I'm going to cover this stock on the channel. And looking at the year-to-date chart, they are actually doing a phenomenal job, up 9% in one of the worst starts of the year ever for stocks. And this company is growing really steady and consistently in terms of revenue. Their margins are something to keep our eye on, so that's the only downside I have found so far. And you can expect a full analysis very soon. And looking at the total return in the past 5 years, they are sitting at 230%, massively outperforming the S&P 500. So this is starting to look really interesting. And not only that, they have an insane dividend scorecard, with a decent 1.7% dividend yield, but really good growth numbers. And looking at their PE ratio, we clearly can see that the company is getting more appreciated by the investors. But it is still sitting at only 14, so to me this feels like it could be a hidden gem. The next stock is NVDA. This stock is down almost 30% from their year-to-date high. And it has been a rollercoaster ride so far for them this year. And don't get me wrong, there's a lot of stuff happening in the world that could potentially hurt Nvidia as a business. But for now, I'm still thinking this tech giant is having a strong moat. Their 12 trailing month PE ratio is a little under 40, and is coming down quite drastically from the previous years. But the thing that I really like here is the same thing as with Microsoft. The forward PE ratio is sitting a little under 27, which is really low for this type of company. And revenue is still going up like crazy. And more importantly, so are the margins. Even though they are showing signs of stabilizing most recently, I still think it is looking really good for NVDA. It's one of the more riskier plays in this list, but I think it could be undervalued right now, especially if we knock another $10 to $20 off the stock price, which I can easily see happening given the rollercoaster ride they have been into this year so far. Next up is TROW price stock, ticker symbol TROW. This global investment company is down roughly 18% year to date. And ever since their peak late 2021, it has never been the same in terms of stock price. And most recently, the earnings weren't that spectacular as well. But what I think is a big winner is that big juicy dividend, coming in at 5.5%, and a 10% compound annual growth rate and 38 consecutive years of increasing that dividend. And again, don't get me wrong, the stock price is struggling, but the revenue is climbing up again at a pretty steady and consistent pace. And again, late 2021 is where shit hits the fan for this company. We see the same thing happening with the margins, but we also see that these are recovering as well most recently. So don't sleep on this stock. They are recovering at a consistent pace, and I'm buying more shares to lower my cost average. The last stock in today's list is Alphabet, ticker symbol Google. This stock is down about 20% from their year-to-date high, but the company is actually doing a pretty decent job when looking at the recent earnings. Growing double digits in revenue and margins are also going up drastically, and so is the EPS. And zooming out on their revenue growth, we clearly see that they were struggling a little bit, but managed to find momentum most recently again, and growth is back on track. And so are the margins. They were also struggling in this area, but most recently it is looking really good. And things are even better when looking at the forward PE ratio, which is sitting at only 18.8, which is really low compared to the actual historical PE ratio. And especially when you keep in mind this is one of the biggest companies in the world. So I'm really bullish on Google, and I can't wait to buy more shares. And that wraps it up for today's video. Stay calm and buy more high quality shares when the market goes down. No reason to panic. And if you do your research, you will find great deals at much lower prices. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and it did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.